Today we're going to talk about how to get your offer accepted in a crazy seller's market. That's me. I'm a mortgage broker. Feel free to ask questions. I don't want this to be a lecture. If you guys have any questions about anything, or if you want to interject some experiences you have about some of these strategies, please do so. Let's make this a conversation. I used to be a high school teacher, so uh, I'm well aware. I remember the 7:30 a.m. class of math, and these just high school students just looking at me like they wanted to be anywhere else in the world, and they weren't even awake. So let's just make this a conversation today. I'm going to talk about some strategies, and I got these strategies from some realtors I work with who are having a lot of great success getting their offers accepted. And some of it is the stuff they're doing it, and some of it is the stuff that I've developed and borrowed from other loan officers that seems to make a big difference. Um, I'm not going to make this very long. It's going to probably be between 15 and 20 minutes. I know your time is valuable. So let's go ahead and get started. Every offer has two components, right? It has the logical numerical component to it. It has the prices and terms, right? The dates and all the stuff that go on the sale agreement. But every offer also has an emotional component. It's just as important. As human beings, we make decisions from an emotional standpoint. We make emotional decisions, and then we kind of rationalize it with logic later on. So we have to realize that the offer we make has to take into consideration the emotional aspect with the seller and the listing agent as well, and the buyers. So we have to keep that in consideration as well. So we're going to talk about a little bit about both of those today. So creating a strong offer, that's the most important part in today's market, right? And we're going to talk about removing or mitigating the contingencies and doing it safely. Because, I mean, your job is to protect your buyers, and that's my job as well, financially, to protect the buyers. Um, and just by removing the contingencies without having any kind of backup, I mean, that's kind of dangerous. So a lot of offers that are being accepted have very little contingencies or mitigated contingencies. And so we're going to talk about some strategies for that as well. So the three contingencies we're going to talk about removing or mitigating are the financing contingency, the appraisal contingency, and the inspection contingency. So removing the financing contingency, that's pretty much on my part, what I can do. So what we can do is what we call a TBD approval. So that means to be determined. Um, Essentially, it's a full underwriting of the buyer with the underwriters at the lender for credit, income, and assets. So they go over everything. It's just pretty much a full approval. We just need a property at that point because we can't do anything about the property because we don't have an accepted offer. So coming in with a TBD approval, a full approval of underwriting, that's telling the buyer, the sellers, and the listing agent, we're ready to go. I mean, we've already gone through underwriting, and we're ready. These buyers are ready and approved already. So that makes the offer a lot more stronger. We just have to make sure the buyer makes no changes during the process. Um, that means they can't quit their job, and you would think that would be a no-brainer, but believe me, it's not. They can't make any. They can't change jobs, right? They can't start any new credit. They can't buy a new car. They can't start a new credit card or credit to buy furniture for their new house or um, whatever. And they can't really take money in or out, large chunks of money in or out of their bank account. So those will all raise flags with the lender because they do a credit check before closing. They do one in the beginning, and they do it before closing. They do an employment check before closing. They actually call the employer to see if he's see if he still has a job, right? And then they're going to want to see the latest bank statements as well. So we just have to make sure that the buyer makes no big changes after they get approved with the lender, and then we're fine. And the other thing that I did put on here is they also check the federal registry at the end to see if they have any delinquent or delinquent mortgages, federal mortgages or loans. And that includes student loans. So if they're delinquent on their student loans, uh, that's a big deal. But I don't know if you knew this, the mortgage application went through a huge revision a few months ago, and they've added a lot of questions. It actually caused a lot of turmoil in the industry. Um, but I think it's better because it asks more questions, and it does ask those questions. You know, are you delinquent on any student loans or federal loans and stuff like that? So if they're honest on that, and I always come back and ask them again because sometimes they just go through the application just to get it in. I just want to make sure. So if we can make sure they have make no changes and that they're not delinquent on any federal loans, I think we're fine. So we can safely remove that financing contingency. So mitigating the inspection contingency. So I see some agents just removing the inspection contingency, which I think is kind of dangerous. You know, myself. I don't know if Nicholas told you or not, but I was a real estate agent for 10 years before I became a mortgage broker. And I would never do that as a buyer's agent. I think I only did it once or twice, and those were with very savvy investors who went in beforehand and looked at the property and did that. Um, so we don't want to remove it completely, but we can mitigate it. We can just say, you know, we're not going to look at the ticky tack stuff. You know, we're going to look at what I call the three S's, what we call the three S's. We're going to look at the structural components, right? We want to make sure that the roof is in good shape, the foundation is in good shape, the house is, you know, the beams and everything is structurally sound, right? The systems are in good shape. Um, the heating, air conditioning, plumbing, electrical, all those systems are in good shape, and any safety concerns, which electrical and other safety concerns. So we're just going to look at the major stuff, right? And I think a lot of sellers who are proud of their homes will not have a problem with that. They just get they don't want a 3-page repair addendum, right? They just want to they just want they're okay with fixing the structural things, the systems and the safety. And I think sellers that would balk at that, you know, might be hiding something. I don't know. So that, you know, we might be saving ourselves from something. So a lot of my agents are just kind of mitigating the inspection contingencies. They're not really removing them, and that's something that's for you to decide with your buyers and with your management. You know, to see if you want to remove that or not, because um, your job is to protect your buyers. You know, that's number one, as is mine. So that's a big decision. And the third one is removing the appraisal contingency. And so this is the one I like the most because it's really out of the box, and it really um, it can really save you in a lot of ways. So right now, low appraisals are the problem. So removing the appraisal contingency, and if an appraisal comes in low and you don't have a strategy to mitigate that, you know your buyers are going to have to either come in with a ton of money, or they're going to have to you know, negotiate, which in this market is really hard with sellers, or they're just going to have to find another house. Um, so this strategy that we use is a great way to remove the appraisal contingency to a point. I mean, we have to go through to a dollar amount, and we'll talk about that in a minute. The strategy works when you're bringing 10 to 20% down. It's a lot harder if you're only bringing 5% down, because we need that buffer, that room, and we'll show you how that works in a second. So what we do is, and we raise the loan to value and pay the mortgage insurance in a lump sum. I know that might not make any sense to you. Um, but the big thing is you don't really have to understand this completely, because I do, and I can relay this to the buyers. I'm going to go over an example to kind of show you how it works, so you have an idea what it looks like. Um, but that's the strategy. We just raise the loan to value and pay a mortgage insurance in a lump sum. And I'm going to explain that in a second. Um, and we remove it to a dollar amount. So that's something we figure out beforehand. Once we figure out how much you're going to how much the offer is going to be. Then we can figure out how much buffer we have for the low appraisal. So, but let's look at an example so that we can see what it looks like. So let's say the list price was $700,000, and for whatever reason, this is kind of an extreme example, actually, but I'll show you how. If it works for this extreme example, it could work for lesser examples. So list price is 700. You guys decide to make a purchase price of 780, and this is if a good appraisal comes in. So appraisal comes in at 780. The loan amount's at 724. Right? It's an 80% loan to value. They're bringing 20% down. Interest rate's about 3%. So their payment's going to be 26, 24 plus taxes and insurance. So their cash to close is 20%. And I'm not going to mess with closing costs. I just want to just do an apples to apples comparison. So cash to close is 20%, 156. So that's if the appraisal comes in good, if we get lucky. The problem is comps aren't keeping up with the higher offer amounts right now, the higher sale amounts. So a lot of appraisals are coming in low. What if it came in a low appraisal? Let's say it came in at 680. Your offer price is 780. Your purchase amount is 780. The appraisal comes in at 680, so it's $100,000 off. Below the purchase price. So they're still coming in with 80%. So the lender's only going to lend 80% of the appraisal amount. So the loan amount goes to 544. Still, interest rate stays the same. The payment goes down, right? Because it's a lower loan amount. It's $336 less. But cash to close is $236. They have to bring another $80,000 in to make this work. Without any kind of strategy to do it differently. A lot of buyers just don't have that. And even if they do, that's a hard pill to swallow, right? So if there's something else we can do to make this work, it would be a lot better. So let's look at the strategy, which I call just we're going to raise the loan to value and buy MI. So same as the second scenario, purchase price is 780. Appraisal comes in $100,000 less. So what we're going to do is we're going to raise the loan amount and have it match the first scenario. But because we're doing that, because the appraised value is so much less, the loan to value goes up to 92%. So that's what I mean. We're going to raise the loan amount, and the loan to value goes to 92%. So once the loan to value goes above 80%, mortgage insurance kicks in. So there's two things you can do. You can pay the mortgage insurance monthly, but we're going to decide just to pay it in one lump sum. So what you can do is instead of paying the mortgage insurance monthly, you can just say, hey, I'm going to write a check and I'm done with mortgage insurance for the rest, as long as I have this loan, as long as I have this house. So in this scenario, the mortgage insurance is going to be about $11,000, a little more than $11,000. Interest rate's going to be about the same. I might have to take a little, a small hit on my compensation to keep the interest rate the same, but that's fine. I'm happy to do it. So the payment stays the same as the first scenario, 2624. And you see, cash to close is just $11,000 more than the cash to close in the first scenario. So instead of having to bring an additional $80,000 to closing, all they have to do is bring in an additional $11,000 to close. The payment stays the same. The interest rate pretty much stays the same. The loan to value goes up. But at this point, who cares, right? As long as their buyers just care about their payment. So the loan to value goes up. The loan amount stays the same. I'm going to save like almost $70,000 in this scenario.
Jesse, my name is Bobby Bay. I have a quick question, if you don't mind.
Sure. Yeah.
Okay. I kind of understand that when you say pay the mortgage insurance in lump sum, $11,200. is that for the duration of the 30 years at a one-time fee, or until the property revalues at 80% or something? What do you mean by lump sum?
Until it revalues at 80%.
Okay.
So once loan to value goes below 80%, the mortgage insurance goes away. So essentially, this $11,000 will pay for a mortgage insurance for loan to value between 80% and 92%. So once you pay that $11,000, you don't have to worry about mortgage insurance ever again. So that's the key to that. I mean, the other alternatives, if they just want to pay, if they don't want to pay that $11,000, they can pay mortgage insurance monthly, just normally, and it'll probably be around $150 more, which is not bad. So they have that choice. I mean, that's just an option to the buyer, that if they just want to pay the mortgage insurance monthly, it'll be $150 added to their payment each month, and then they'll just bring 156 to close, just the 20% down payment again, or the same down payment. So that's their choice, right? Um, so in this sense, you can pretty much write the offer saying, hey, we're okay if the appraisal comes in $100,000 low, we're okay. We're fine. We'll guarantee that. And so we'll remove the appraisal contingency up to $100,000. If it comes 110 below, then then we have to negotiate a little bit more. Then it's a negotiation. But that's kind of powerful, And this is an extreme example. $100,000 appraisal. The appraisal comes in $100,000 low. That's an extreme example, but it works. It still works at that amount. So even if you're at a lower sale price and the appraisal only comes in $25,000 more, and the buyers are bringing 80%, I mean, that's an easy one to do. So, so why does this work? Well, a TBD approval, which means we're approving the buyer before they make the offer. They're approved buyers with the underwriters, with the low appraisal strategy we just talked about, and just saying, hey, we're not gonna go crazy with the inspections. We're just gonna make sure it's a good house, and then we're fine. That becomes a very strong offer, and this is why some of my agents are having a lot of success, because they're coming in with these three things, and it's working. Does anybody have any questions about these? I kind of rushed through them a little bit.
Jesse, there was a question in the chat about
Yeah.
Does the PMI or the MI go away automatically? I think you still need to get an appraisal, correct?
It depends on the lender. Some lenders will just they can do an automated valuation, and it'll be fine.
Okay.
Yeah. Cool. The only reason you need appraisal is if your home increases in value, and that calculation with the increase in value and your loan amount, that new calculation is at 80%.
Like
they'll probably want a new appraisal.
Yeah.
But if they're using the sale price, the old sale price, and it goes to 80%, they don't need an appraisal.
Okay. And then Mary was just saying that she just had this on a deal, and the lender wouldn't even explain, I guess, it this way. And the fact that you showed it this way was very helpful. So thank you.
Right. So, who said that, Mary?
Yeah.
So, Mary, here's the key to this. This is why it works. Because we talk about this before we even make an offer, right? We're talking about scenarios. Hey, we're going to have to make an over list price, and this is what it looks like financially. These are what the numbers look like. So the buyers are mentally prepared to make that offer going in, right? So that makes a huge difference. And the other part is buyers are educated and prepared for the low appraisal. We talk about that as well. We talk about the scenarios, what happens if we get a low appraisal? We're going over a list and the appraisals are coming in low. Here's some scenarios to mitigate that. And this is what the numbers look like if we get a low appraisal and use this strategy. So the buyers go in prepared. The buyers go in making an over list offer with more confidence, right? They have less questions because, you know, we all know the buyers who have questions or are confused, they're going to find some way to get out of the deal. It's that simple. This is a huge deal for them, right? Most buyers don't know as much about real estate as we do. And in fact, you know what? I flip properties. I have rentals. I've bought over a couple dozen properties myself, and I still wake up in the middle of the night when I buy a property and so what have I done? You know, I ask myself, what have I done? And I've been in the business for 15 years. So imagine what buyers are like. So you have to educate them about this stuff. You have to talk to them um, in your presentation about what the market is like. How many days are homes are staying on the market? Not many. What is the sale versus list price? We're seeing everything go above list price. What's the percentage of that? So that's what you need to talk about. I need to talk about the financing part, telling them what the numbers look like um, if you make an offer $50,000 over list, telling them what the numbers look like and the strategies are if we get a low appraisal. So when they go in to make that offer, they're more confident. So when they get that low appraisal, oh, we talked about this. It's not a big deal. These are the strategies we talked about. Which one do you want to do? That's a no-brainer. So that's why it works. Not only it works numerically, right? But it's the emotional part. The emotional part, the buyers, that they're ready for this stuff. So let's talk more about the emotional stuff. We've all heard know, like, and trust, right? But that goes to the listing agent as well. A lot of my agents that have success call the buyer's agent. Call the listing agent, right? You want to build rapport with them. Agents want to work with people they know and like. When I was listing homes, absolutely. If I got a call from a buyer's agent and we hit it off, I would try and get that offer accepted if it was a good offer. Absolutely, 100%. Ask questions about the offer. How can you tailor the offer to the seller? What are the seller's needs? What's most important to the sellers? Is it just money? Do they need time to move? Do they want strong buyers? Do they want people they like to come in the house? The question I love is, what can you tell me that will help me make a great offer? If the listing agent likes you, they're going to help you, right? If you can get them on the phone, right? So the emotional part is very important with the listing agents. And the other thing is, I always make the phone call as well, because I want to explain these strategies. I want to talk about the strength of the buyer. I want to talk and I'll ask my buyers, how much information can I give? How much information are you comfortable with? Because the more information I can give, if they get a 820 credit score, can I tell them that? If they have a fantastic job and we approved them easily, can I tell them that? Those are other, if they want the house, they usually say yes. So I talk about the strength of the buyer. I tell them that the buyers are approved with underwriting. We're ready to go. They've already been approved with the underwriter. The loan's been submitted to the lender, approved. We're ready to go. We just need a property to approve at this point, and we're ready for a low appraisal. These are things we have to tell the listing agent, and that's my job. That's my job, to get on the phone with them and talk about this stuff, right? And also to develop rapport. They want to work with people they like. They want to work with lenders they know. Well, not know, but lenders they like and who are professional and they feel comfortable with and who can close. If I'm talking about these three things, the strength of the buyer, the TBD, and the ready for low appraisal strategy, they're like, oh, this guy's been in the business a while. He knows what he's talking about. Um, the hardest part is getting them on the phone sometimes. They're so busy, they don't answer the phone. So if I can't get them on the phone, I'll do a video. I'll create a video with all this stuff and just send it to them. I'll send it via email and I'll text them a link as well so they can look at it. And I can tell when they watch it too. So I can follow up with a phone call and try and get them on the phone. So the emotional part, right? People want to work with people they know and like. And I think the loan officer call really, really helps as well getting your offers approved. So some miscellaneous strategies that are not the big three that I like. So I think in this market, you have to do your best offer in terms up front. You can't just put an offer in and hope to negotiate um, a better price, or if there are multiple offers, up your price later on. You have to get your best offer in terms up front so you can be competitive. Offer to pay sellers closing costs. Talk to your buyers. If we have the money, if it's if it's doable, we can pay for sellers closing costs, and it's not a whole lot of money. Buyer's love letter. All right, Nicholas and I talked about this. This is against NAR rules, I guess. The attorneys don't want this done anymore because uh, there's a possibility of litigation, of being sued, and I get that. Um, but Nicholas and I were talking about this, and we're going to talk to the management at Coldwell Banker, because most of the liability is with the listing agent and the seller, right? The buyer's the one who's going to initiate the lawsuit if they feel like they've been. And for those who don't know, the reason that the buyer's love letter is just a letter you write about the buyers with a picture and all that stuff. There's a possibility of discrimination if it's a person of color or something like that. If the buyers think that they were discriminated against because they're different for whatever reason. So the attorneys at NAR have said we shouldn't be doing this. But the liabilities with the listing agent and the seller, not the buyer's agent and the buyer, because the buyer will initiate it. But still, it's against company policy. So, but we're going to talk. Nicholas and I are going to talk to the management to see if it's okay if I initiate this letter with the buyer and keep the Coldwell Banker agent out of it, because there's no. I don't feel there's a whole liability on me or the buyers. The liability is with the listing agent. So we'll see. I think it's very helpful. When I was a listing agent, I know for a fact that the letters we sent oftentimes helped, because there again, it's an emotional process. The sellers want to sell their house to a family who's going to take care of their house, right? Because they raise their kids there. They want to. It makes a difference if they get a letter and they fall in love with the buyers. That's a big deal. So we'll see. We'll see if we can do it or not. Personal touch. A loan officer friend of mine said he had an agent that did this. While they were touring the house, they saw the guy loved whiskey. He had pictures and whiskey, great whiskey. So he wrote in the contract, buyer to pay $5,000 closing costs, but also to present a nice bottle of whiskey to the sellers at closing. And the sellers love that offer. So I don't know. Is that a RESPA violation? I don't know. We'll have to see. But again, it tugs at the emotional part, right? We want to make a difference. We want to stand out somehow, and offering a nice bottle of whiskey. I heard a story during COVID. Someone offered like toilet paper or something like that, like many rolls of toilet paper. So that was pretty. If nothing else, it makes the sellers laugh and the listing agent laugh, and that makes a big difference. Rent back agreement. If the sellers need time to move, and if your buyers can do it, why not? You can't do it more than 60 days. The loan requires people to move in within 60 days, and all conforming loans have that requirement. So you don't want to do it over 60 days or it becomes an investment property. Largest EM possible makes it sound like you're serious. An escalation clause. I used to use escalation clauses. I'm not sure they're great in this market, but something you can think about. And this one is submit a complete RPA, your purchase agreement. I was surprised when I was a listing agent how many crummy RPA, we call them sales agreement in Portland, sales agreement I got. Incomplete, horribly written. I'm not going to do business with someone who does that. Absolutely. So submit a complete RPA. You know, I never left blank lines. I would just put an NA or something like that. So that makes a big difference. And just a closing thought. I mean, right now in this market, and we're focused on price. We're focused on days on market. We're focused on how many offers there are. Just don't forget about the human side of our business. I mean, it makes a big difference. It makes a huge difference. Standing out uh, uh, amongst other offers and getting your offer accepted. And that's it. Quick and easy. But some of these are very powerful, especially the big three used together. That creates a very strong offer. Anybody have any questions? Well, great. I appreciate your time.
No,
And if you want to get in contact with me, here's my contact information, or you can just talk to Nicholas.